Thank you so much for that, ladies and gentlemen. Lots of interesting insights, and we'll try and connect all the dots. But Isabel, I want to pick up on what you were talking about, the role and the relationship between the private sector and the government. And this panel is called How to Save the Market Economy. You could argue that we haven't really had a normal market economy for the better part of the last 3 to 5 years. Why? Because we've unfortunately been through a number of crises. COVID, energy crisis. What I want to know from you, get your smartphones out, how big should the role of the state really be? We've got a couple of questions for you in the Menti. Should the state shield consumers and businesses from all risks? Get the code, 344449. Should the state shield consumers and businesses from all risk? Yes, this is the most important task a state has. No, otherwise businesses and consumers develop a zero-risk attitude. In German, we have a great word for this, Vollkasko-Mentalität. I don't know if there's an English translation for that. Or no, it distorts competition in the single market, as we had discussed earlier on today with Joaquin. So I'll give you a couple seconds to make your selections. Okay, it's pretty clear. 2/3, 65% believe no, otherwise businesses and consumers develop a zero-risk attitude. Competition, much less of a factor here, but still 30% of you are concerned about the anti-competitive effects this might have. Christoph, we're still doing it though. In every crisis, every government is doing it. They're trying to shield their consumers and the businesses from the pain. Should they continue to do that?
Yeah, it's difficult for me to answer because if the Swiss government would have shielded Swissair from going bankrupt, I wouldn't be sitting here. So in that sense, I'm absolutely biased. But at the time, there was a clear decision that market forces should prevail. The company had not the right reserves to survive, went bankrupt, and the government let the company go bankrupt. And then there was a second decision being taken that maybe that air transport is a kind of an essential infrastructure for a country like Switzerland, and we need something like an airline linking Switzerland to the world, particularly to also long-haul destinations, and there was a decision taken to basically invest money into it, not only government money, but so majority was not government money, but essential part of it. So in that sense, we see some cases where the collateral damage of not intervening might be very detrimental for a country at a specific point in time. But generalizing it in the sense of protecting private companies from all risks is a little bit a perverse even thinking, because it would exactly refer to what Isabel just mentioned. We would then basically privatize any kind of profit, and in the case of losses, the government would intervene. The problem is the decision when to intervene, and what are really good reasons and what are also maybe bad reasons. So the question is always, if a player in the market is disappearing, is there anybody else taking his place and offering these services, at least after maybe a certain time. And that is not easy to answer, because you need some faith in the strength of the market, basically into the incentive for others to stand up and deliver this kind of supply.
But you point out a very important question. At what point does the government step in? What is the right threshold in a way? Is that when, for example, social peace is threatened, as could have been the case in Europe this winter if energy bills are too high? Is that when the government steps in? Or is it stepping in to make sure that everyone has a basic standard of living or a basic level of profitability? Isabel?
I think the issue is when we're talking about the energy supply for this winter, the government was stepping in not because, in Switzerland at least, because it was concerned about individuals' monthly bills, but because it was concerned about whether there would be enough supply for the economy. So these are two different things. It wasn't meant to like alleviate the pain for the individual households. So we're talking about really saving big companies. But yes, they are essential for the functioning of the whole economy. Now, where's the threshold? Well, obviously, once you're at this point, you don't want to run the train against the wall. Mm-hmm. The question is a little bit, how do we get there? How did we end up in a situation where we do have a few crucial companies that, if they go bankrupt, we are in a situation where we say we don't know how to run the economy this winter because everybody needs electricity.
Mm-hmm. Martin, so I guess, is it down to the big utilities of this world? Is it down to an airline? At what point do we decide, okay, this company is actually, or this sector is too big to fail? Do we step in when one of the big tech companies is in trouble because it is essentially too big to fail? Your thoughts?
Well, I think one question is at what point the government steps in. The other question is how they step in and what they do, right? So suppose the concern is about individual households being able to pay for the groceries and the energy bill. Well, you can either take out taxes from fossil fuels, or you can make a lump sum transfer but keep the incentives for energy saving the same. And I think much of the discussion in the last few months in the public domain and between economists and the public was about how to preserve the incentives to save while at the same time also being able to alleviate rising inequalities.
Mm-hmm. As we talk about incentives, Christoph, you made the point, the industry that you're currently in, the pharma industry, very, very much needs those incentives to innovate. And Roche is one of the top spenders when it comes to R&D. I think you usually top the league table. 14 billion Swiss francs is what you usually spend on that. But now we're seeing new regulation out in the US. There's also talk about the government being able to set lower prices in Switzerland. The Inflation Reduction Act tells you that the government can now negotiate the drug prices. Does that still give you the right incentives to keep on innovating and spending all that money on R&D?
Yeah, we'll definitely have the right incentives. The only question is how much do we spend on research innovation and what does society expect as speed of medical innovation? That is the question, because if we do not get the innovation premium, which is adequate to invest more than 20% of our sales into R&D, then we will adapt. I think we should not underestimate our capability of adapting, and we do this, for example, by adapting our R&D spending, but I think a very important element is that companies, and not only big companies, we are in the end acting on a global scale. So whenever the conditions in one country are deteriorating, we will maybe shift resources to other countries. And that is always also the problem. If we think about market regulation, etc., we are thinking very much in terms of national markets. And we should keep in mind that for us it's a very dynamic exercise. So if we, for example, introduce progressive taxation, we can do this. Actually, we have in most countries progressive taxation, depends on the level now, but if taxes are getting too high, we will shift our business to other countries, or there are elements like patent boxes or whatever. So there are ways and means to adapt. And that is something which is also important for regulation to keep in mind, this kind of staying competitive on a global scale.
Mm-hmm. When it comes to innovation, you've done a lot of research on this. One paper stands out to me. It is the paper called The Bright Side of Common Ownership, and relating back to what you were talking about in your little statement before, usually you would think, and as you pointed out, there are negative effects emanating from common ownership. With regards to innovation, why is that the bright side? How can this solve the problem of anti-competitive behavior?
Yeah, thanks very much. I was also tickled by his comment on innovation. Biotech, of course, is not exactly known to be controlled by Vanguard and BlackRock, but by entrepreneurs who don't particularly care about stealing market share. In this case, the issue was that a new market was created for a vaccine that didn't exist previously. Now, the paper you mentioned makes a point that, in theory, one could imagine that common ownership could have a bright side. Namely, a usual problem in innovation is that one firm says, if I invest money right now to come up with this technology, but others free ride because there's no patent system that would protect the innovation, if there's a technological spillover, we call it, well, then the firm will underinvest. It doesn't have the incentives because it won't reap the entire benefits, because other firms might free ride. Come to the rescue the common investors of all the firms, because they don't care which firm does the investing, which firm does the reaping innovation part. Which is, by contrast to the innovation I was mentioning in the airlines, where you say, look, if I come up with a cheaper production process, that has just the effect that I steal market share from a rival, that doesn't really affect portfolio profits. So theoretically, the effect could go either way, and it depends on whether the technology spillovers are more important or these product market effects. Now, that was all theory. The problem is, we haven't been able to find a lot of evidence for the notion that common ownership would increase innovation, even in the cases where you would imagine it to happen. So there's a question mark at the end of the title of that paper.
There should be 2 question marks then.
So we really tried. We're not done yet. We might be able to find some if we squeeze really hard, but for the moment, the evidence has been hard to come by that common ownership would help with innovation.
Okay, we'll wait for further research. Staying in the pharma sector for a little bit, and then I want to move on and get the audience involved. Obviously, there was so much investment that went into the mRNA by Pfizer, BioNTech. It worked in those cases, as you pointed out. In other cases, it did not work. And then the WTO waived those patents for the emerging markets. That's a big, big setback, isn't it?
Sorry?
That's a big setback. The WTO waiving certain patents for the emerging markets.
Yeah, we feel definitely that this is a big step back, because the first thing is it doesn't help to provide faster access to vaccines. So it would, if there is a problem, the logic is the patent is preventing people to get fast access to vaccines. It's simply not true, full stop. I don't go into the detail. It's not true. And now we have this patent waiver coming up, and who should take risky decisions, like, let's say, the CEOs of BioNTech, which was not a big company, and for them, redirecting research capacity into development of a mRNA vaccine against COVID-19 was a super courageous entrepreneurial move linked with a lot of risk. They had a knowledge about mRNA vaccines, but not about COVID-19. They didn't know that they were successful, and they took the risk, also investing financial means. And then if you then think, as soon as you are successful, and only those who are successful, you get expropriated your patent, a very strange logic. Obviously, it does not mean that the owners of BioNTech are not willing to bring the vaccine to everybody globally who needs it. So, but in these cases, you give licenses, etc. There are other ways and means how to give access to everybody. And actually, the problem is not the patent. The problem is that we are now having, I think, 19 billion vaccines this year, and 2 years ago, 0. And there is it's a little challenge to ramp up manufacturing from 0 to 19 billion. And this is exactly what has happened. And it was the market economy with all the incentives being successful in this respect.
I just wanted to observe that. Here is a manager of a firm who actually cares about that particular firm's welfare, and who gets understandably upset at essentially getting expropriated and the patents not getting enforced. This is by stark contrast to the institutional investors that own the other pharma companies, who literally asked them to stop enforcing patents against each other. Okay, so all of that just to say, different ownership structures of firms have very different attitudes towards protecting innovation and encouraging innovation.
want to stay with you for a moment because we're getting some interesting audience questions. Is the shareholder structure of the top 10 pharmaceuticals the same pattern as airlines? I don't know if you've done any work on pharmaceuticals.
I'm pretty sure he knows that better than I do. What are it?
Yeah, it is interesting to observe that Warren Buffett, for a very long time, he refused to invest one single cent into airlines. And it was only after all major American airlines had lived through Chapter 11 and had got rid of their huge debt burden, and then all of a sudden the industry consolidated, and there were only few bigger airlines with bigger networks existing, and all of a sudden that happened what every company is striving for, pricing power. Everybody wants to have pricing power, and it is limited by competition, obviously. And there was less competition in the US, and all of a sudden, whoops, the airlines were all nicely profitable, much more profitable than any European airline. And that was the moment when Warren Buffett had the insight, oh, I will invest into airlines. And we see he doesn't only invest into one airline, but several of them. And actually, a company like Lufthansa, we invested into JetBlue Airways. I was on the board of Jet. We were biggest owners. But government regulation not allowing for more majority foreign ownership in a US airline prevented us from increasing our share, and then we stepped out at some point in time again. So that obviously limited competition. In the pharmaceutical industry, I think the ownership is fairly meaningless because in the end of the day, you have to make sure that you get approval for new medicines, and this is essentially due to serendipity and the intelligence of your researchers and not of any kind of ownership. The only difference is when you have a family ownership, like for example in the Roche case, then you can afford to look for the long term and thus also in times of economic crisis continue to invest into R&D, whereas let's say a company which is, has a broader shareholder base and has to comply with next month quarterly results, then you will look and cut back, for example, also meaningful R&D expenses to have a nice profit for the next quarter.
I want to take it back to the overarching theme, how to save the market economy. I've got one interesting question or a comment here that do we even have to save the economy? Couldn't we take this situation to employ a new system? Philosophical question. Isabel, what I want to get to you from your perspective is, because we've talked about the impact of big tech, the rise of the superstar firms when it comes to inequality, has detrimental effects. I just want to share with you some figures from the Congressional Budget Office. They show between 1989 and 2019, the richest 1% of families increased their share of total national wealth from 27 to 34%. Families in the bottom half of the economy now hold a mere 2%. A record share of the nation's wealth remains in the hands of the nation's billionaires, and with that they have considerable sway over politics as well. So how do we fix the inequality part of the market economy?
Well, one aspect is that if you think that the high inequality in wealth especially has an influence in terms of power and influencing politics, that's one part that you would want to regulate. So how do we organize who can donate how much to what kind of campaign, to how do we finance politics in the end of the day? How much influence can lobby groups have? But then of course there's the other question, like what does it do to society if the individuals, I think it's in the end of the day, it doesn't matter that much how big inequality is, it's much more also about how individuals in society feel, how much they're left behind. So if you think of the protests in France, the Gilets jaunes, I think in the end of the day, it was more the result of this feeling of being left behind, where you have a wealthy elite, where in the end it doesn't matter probably so much how many euros this elite owns, but really this feeling is there, this polarization within society. So I think what you observe on Twitter is probably something that is also happening to some degree in society, and I think that's when it becomes problematic because it has huge consequences to how our democracy works. For example, in Switzerland, we have this we participate a lot in the democratic process. But what does that mean if some people more and more feel that they're left behind? Politics are not being done considering their situation. I think this increases tension, not only on platforms like Twitter, but really also in real life.
But how do we fix it then? Is progressive taxation, is that the only way to fix inequality? Are there other measures?
So as I said, so if we want to protect the market economy, we do have the regulator there to do, I mean, the competition authorities can regulate some aspects of it. Progressive taxation, I mean, to be fair, in Switzerland, income inequality isn't as large as it's in the US, for example, by no means. But wealth inequality is high, also by international standards. There, I guess the question would more be if you want to tackle that with taxation. So we already have a wealth tax. The question would be, does it need to be more progressive? Or do we need to have an inheritance tax, something that we don't really have at the moment in Switzerland?
Mm-hmm. Martin, I think one of your papers, some of your research also focuses on the idea, should the worker have a bigger share of the profits through greater stock ownership? I know this might be too simplistic of a view of that would solve all the problems in the world, but is that one of the avenues you can have the worker participate to a much greater degree, but also, I guess, the losses then. They also participate in the losses quite substantially.
Yeah, so I have very long answers to all these questions, but it is definitely true that culturally we have quite low stock ownership in Europe, no? And almost a hostility towards market economies. And it's a more general observation here that with all the political involvement in times of crises or more generally when they want to subsidize, that's very popular. It is kind of really unpopular with large swaths of the population and definitely with shareholders to have strong market incentives. Strong market incentives don't increase profits. They actually decrease the profits but make the consumer prices cheaper. So a lot of that has to do with what is politically feasible, and I think one issue is culture, just a matter of not being friendly towards market economies in the first place. I think we also saw it in the question that asks for system change. Now, there's a political dimension to that. I'll narrow it down to the political part. So why do we want to change away from a market economy? Again, because it didn't deliver on its promise. But in that case, I'm not sure we gave it a fair shot, in the sense that with all the incentives that we distorted, it's not that we saw the outcome that was the true promise of it. Now, as a solution, if workers owned a greater share of stocks, yeah, that would give them higher returns. But on the other hand, there's a reason they don't own them, because they don't want to bear the risk. So I think the issue is more fundamental. The more fundamental issue is that if you have less than perfect competition, let's say, or even declining competition and increased profits, who benefits from that? Right? So who benefits from higher consumer prices? Well, that's the firms and their shareholders, but the shareholders tend to be the largest, so among the top part of the wealth distribution, as I said. It's not uniformly distributed. Whereas the consumers are more uniformly distributed across the population. Poor people consume not the same fraction than the rich parts, but it's more the same than the distribution of wealth and stock ownership. So yeah, if we were able to get a more uniform distribution of stock ownership, that would be great. But there's no way of doing that without.
Well, you could reform the pension system. There's talk about that in Switzerland. There's, in Germany, they're making big strides. That's a first step.
That's right. That's right. So that's one way of reforming it. There, the devil ends up being in the details, because you might actually end up with a system as what I showed on the slides, right? So the result of the Vanguards and BlackRocks of this world being so large is, among others, because of the US reforms of their pension systems, and because of a greater willingness of the population to invest in the stock market, and because of the fantastic innovation of Vanguard of offering funds for real cheap. That's why I am an investor in these funds. That's my disclosure. They're fantastic. But the problem is that what is good for shareholders is not necessarily good for society. That's only true if you have if you have strong competition. And that's why I think at the center of much of the debate of today was how we can strengthen competition in order to lift the potential of the market economy before we have to move to system change and so forth. And the problem with system change is if you want government to take more control and, say, have more centralized control of the economy, that didn't work so well the last times we tried, right? And the reason is because you're getting rid of the incentives to compete. Now, the trouble we find ourselves right now is that you got rid of the incentives to compete because of centralized economy control, but not by the government, but by the private actors. So I think that's why we're in the situation we're in, and we hear the questions that came from the online audience.
I see a lot of questions here. We have questions in the audience as well.
Hi, you talked about how ownership influences the competitive nature and innovation. You could also look at that on a per company basis. So for example, Roche, of course, has many also competing solutions for the same medical issue. But Roche, in this case, owns all of them. Would you argue that there's also an incentive not to compete inside one of these companies if there are many competing solutions to the same problem?
I mean, yeah. If two companies compete aggressively within their own companies, I mean, to encourage innovation, sometimes you try. But as a general rule, you wouldn't expect the same level of vigorous competition within a firm than across separately owned firms.
Want to comment on that?
We partially apply this thinking in our research structures by not relying on one integrated R&D organization, but we have built up several, in the end 4 autonomous research and development structures for the early research. So when you really need a broad spectrum of different ideas, because all structures, if you have one monolithic structure, you may have a very gifted head of R&D, but every gifted head of R&D has a certain, also his ideas, his preferences, and all his direct reports, they get a very good feeling, what does my boss like and what doesn't he like. So in the end, you have a certain bias in such an organization. And in the case of pharmaceuticals, you might be betting on the right horse, but you also might be betting on the wrong horse. And when you bet on the wrong horse, and then all of a sudden you have spent a lot of money in your R&D structure, and nothing is coming out, you do not get approval for a new medicine, then you are shrinking because your old patents are expiring, and then you have to shrink the whole company. So it is a kind of an existential threat. And in this sense, we are betting on let many flowers flourish and have many ideas in parallel, in this sense compete also for good ideas. And only later, when it comes to big clinical trials, then it's more a kind of an execution to run these trials, and then we have one company, structure in the company doing this. But in the beginning, we are very broad, exactly with this kind of internal competition idea.
There's a question here.
Martin, you mentioned the anti-competitive effects of common ownership. What's your solution?
That's a tough one. So the short answer involves you want to have large shareholders who care sufficiently about one firm to actually invest in governance and monitor management and so forth. But you don't want these shareholders to also have huge financial stakes in the competition. Whichever detailed solution people have come up with needs to have this element that the end result has to be that the largest and most influential shareholders don't own the competition. Now, how precisely you implement that? Well, there's a very robust debate in the law journals. Some people say, look, we'll just take away the governance rights, the control rights of index funds. Well, I mean, on the face of it, that would lead to some pretty large problems because you would have the largest shareholders of a whole bunch of firms, of most of the firms, not exercise any sort of monitoring duty anymore. Okay? What you see these days in the press is the large asset managers trying to get their get themselves out of trouble by passing on the voting rights to the ultimate investors. The likely outcome of which is these voting rights won't get used. So that makes things actually worse in the sense that you have fewer large block holders who care about that firm actually monitoring management and managing agency problems. But that doesn't take into account that this will change the entire makeup of the asset market. Because if then I, as a non-common owner, as an activist hedge fund, can buy control of a single firm with less money, well, that will change the entire equilibrium ownership structures of all the firms. And so this is, I think, where much of the hope lies in many of the proposals that have been made. And again, that's not popular. Ask any corporate manager about how much they like it when an activist hedge fund buys stakes in their firms and says, what about you start cost cutting and firing a few employees? That's not popular with the managers, it's not popular with the employees. But in some ways, it's a bit of how capitalism is supposed to work. Right? So this is where the unpopularity of the measures to strengthen the market economy come in, and which is why it's a constant fight to keep the market economy to function.
There are more questions.
You might not have that problem because of a certain, when you have a large family, then they care about it. And but I think everybody can read in the press about what happens when the activists come in.
They always say we actively engage with every shareholder. That's always the press release, right? But it's behind closed doors. There's a big fight usually. Not pleasant, no.
So Isabel, you emphasized the role of progressive taxation also on firms, and then Christoph, Franz, I think it sounded a bit almost like a threat that you said that if conditions in a single country deteriorate, then companies might also just move away. Now we have an initiative at the international level right now to actually try to coordinate this. Policymakers have understood that just raising taxes in one country might have these effects on very mobile firms. And so like the OECD proposal is, for instance, with the minimum tax to actually prevent that kind of tax competition from happening. So I was just curious to get your take on those kinds of initiatives. Would Roche really now move away from Switzerland if the tax burden actually increased because of these kinds of policies? And more broadly, how do you see the role of international tax competition in helping or not helping to save the market economy more broadly?
I think fortunately, there's more than one element which creates attachment to the places where you do business and where you create your sites. And it's definitely not only tax or a minimum tax, but for example, availability of qualified employees in a certain place, quality of life for stability, also legal stability in a country. So there are many elements which create loyalty towards, for example, a specific country. And we should not, in this sense, only focus on taxes. Obviously, if you are in a specific tax situation and nobody likes that you have to pay more taxes than in the past. It's probably more an issue of how is a country like Switzerland dealing with the additional income. Is this, let's say, reinvested in the places where the additional funds are coming from in order to basically at least partly compensate the disadvantages by bringing other positive elements, whether it's then childcare elements, whatever you can do in a specific canton. These are the kinds of political discussions which I think are important, but it's clearly not the minimum tax which will, for example, incentivize Roche to move on. But for example, if then we see proposals like a maximum of 500 francs per inhabitant of a canton should remain in the country, remain in the canton, and everything else is distributed. And then you realize, oh, we are talking about Basel and we are talking about Zug, and who is the biggest employer in Basel and in Zug, and then we feel, okay, this is an anti-Roche legislation. And obviously we're not super enthusiastic about it, but it will probably not mean that we will go out and choose other cantons. Or
The
other
fact that you're
countries.
not super pleased about is probably an understatement, but moving a huge operation like Roche out of a country is also hugely cost intensive. I mean, the minimum tax rate, the global minimum tax, will only work if there are no loopholes, if everyone adheres to it, right, Isabel?
Well, yes, and there's a further aspect here, and that's why I was talking about these bailouts. Of course, you can now say, well, all that matters is tax. Just said, no, it's not all that matters. But if we are moving towards this world where companies are more and more getting used probably to this idea that there are several instances where the government will jump in and hand out some cash, then maybe that's another consideration that you might have where you position yourself. How likely am I to be bailed out in the future? And just more broadly, with this pandemic, we've seen that the government, there's some things that governments in a crisis can probably do better than one single actor. But the question is then also, how do companies see their own responsibility to contribute to that? Because you said that it was the private market that solved everything. But at the beginning, at the onset of the pandemic, there was large government interference or in government action, and not all of it was bad. I mean, we needed a lot of these things that were done by the government. That governments were replacing incomes, and governments were making sure that people were safe by giving them the possibility to stay at home, and all these kind of things. So the question here is also a bit: how do companies see their responsibility to contribute to this larger system?
Martin?
And their taxes are part of the story.
Okay, what should I say? We are paying 7 times as much taxes as we have sales in this country. Is there a proof of bigger loyalty?
No, but the question is, how much would you pay if you were in Germany?
Well, we pay a lot of money in Germany.
You're a big company. You're going to be paying a lot of money everywhere. That's clear. But that comes with the territory.
That's true, but as I said, we employ more employees in Germany than we do employ in Switzerland. So I think the German government they are big fans of a company like Roche, paying a lot of, not only a lot of money in form of taxes, but a lot of investments which provide, for example, jobs for the construction business in the country. But most important, we provide first-class jobs for highly educated people, and everybody pays again then income tax in the country, which I think is also loyalizing people being educated, for example, in Germany, then working in Germany, then also giving back instead of incentivizing them to move on to the US with a good taxpayer-paid education from Germany. That's not the idea.
Martin, final comment from you, and then we'll wrap it up.
Yeah, so I'm just noticing that we're debating lots of big systemic questions, and I claim that here the ownership structures are changing everywhere. But I don't want us to lose sight of that we can also take baby steps in order to improve the system one step at a time. So I want to go back to Professor Fair's question about, so what are you going to do about it? Look, there might be disagreement about whether we should just allow Vanguard to continue growing as much as it did in the past. But can we agree on that Bill Gates' family office shouldn't allow to just buy 30% of all the publicly traded waste management firms? Or, there seem to be some low-hanging fruit that seem kind of like no-brainers that wouldn't have huge systemic effects.
So it
and where
goes back to regulation, you said.
Or where it's just a matter of political will, of whether we actually enforce existing laws. It's just been in the last 2 weeks or so that the US Department of Justice has asked directors to step down from boards of direct competitors, private equity managers. Well, that's just a per se violation of the law, and it has taken many, many years of academics pointing out that this is a problem before the regulators started to act. So I think, in some ways, debating the big systemic issues has the effect of holding up small baby steps that are real no-brainers in order to address many of the issues that we've debated today.
Okay, baby steps to save the market economy. I want to thank all of you for your input. Thank you, and your questions as well.